Well, the stock market is on pace to have its worst January in history, and the Nasdaq alone is set to have its worst month in general since December of 2008. That is a long time ago, and things are very, very ugly out there in the stock market. On top of all of this, we know that volatility has been increasing and that valuations haven't properly reflected fundamentals in the stock market for at least 2 years now. And if you're wondering why that is, this video is not the video for you. Go watch my most recent video. In today's video, I'm going to be explaining to you why I believe the current stock market is a big trap for investors and ultimately what I think is going to happen throughout the rest of 2022. But as always, I'm not a financial advisor. I'm a 20-year-old kid speaking through a microphone to you guys watching this video on YouTube. Please don't take anything I say as financial advice because it's not. And one last note, I'd like to get this out of the way early. If you guys are new here or returning not yet subscribed, I would greatly appreciate you hitting that subscribe button down below. And also comment below a stock that you've been buying heavily as the market continues to dip. Without further ado, let's go ahead and get into this. To start things off, let's take our minds back to January and February of 2021. Perhaps that was the biggest bull trap in history. In fact, most people that were plowing money into the markets in January and February either have exited the stock market at this point or their portfolios are down significantly today. However, despite even the biggest stock market YouTubers like Meet Kevin completely selling out of all of his stocks, I believe we're in the exact same scenario now, just on the other end of the spectrum. I believe that right now, bears and short sellers are the ones being trapped. Now, let me explain to you why this is. For starters, it doesn't matter what market index you look at, short interest on any given trading day is exceeding 40%. And 40% is extremely high for individual stocks. But when you get into the territory where over 40% of the shares sold on any given trading day is from short sellers, that means that there are very few natural sellers left in this market. I mean, think about it. Any stock that's popular on YouTube or amongst retail investors is likely so negative right now that less than 1% of the holders of that stock are probably in the green at this point. So right now, you're getting to a point in a lot of stocks where the only remaining shareholders are the ones that truly believe in the business model, that truly believe in the company behind whatever ticker symbol or behind whatever stock they are buying. And those individual investors are the ones that are least likely to sell. Because if they have that conviction and the confidence in their investment, they're not going to sell it out for cheap just because they're down. We're getting to that point with a lot of stocks right now, and you can see based on the short ratio on any given trading day that the market is just running out of natural sellers. So when we look at the S&P 500 and see over 40% short volume on any given day, or the Nasdaq with over 50% short volume on any given day, or even the small caps, the Russell 2000 having over 60% short volume on any given day, you can start to recognize that this is getting very overextended to the downside. Generally, what works in the stock market is not what the masses are doing, and right now the masses are shorting stocks into oblivion. One other thing you have to realize with short selling is that every single short seller is forced to be a buyer of that stock or that index at some point in time, which puts immense buying pressure onto stocks very, very quickly. And as a matter of fact, this is generally kind of a snowball effect, where if one short seller finally buys back the shares to cover their position, it forces another short seller to buy back their position, and another one, and another one, and another one, again, putting increasing buying pressure on these stocks and the stock market in general. Another item that I've noticed, which is pretty exciting, is that volume in the stock market is finally starting to pick back up. As these stocks have been crushed, the volume has generally been pretty dang low, meaning that there just weren't many buyers to meet the sellers, which meant the sellers were just going to crush the share price down to a point where they found buyers of the stock to match them. And that's exactly what's happened. But just recently, over the past 2 or 3 trading days, volume on about any stock that's been beaten down is extremely high right now, which is another bullish indicator. Whenever you get higher volume, it generally means times are changing. The next thing that's really pointing to a bullish reversal is the fact that large companies and oil prices are finally starting to fall. Those are two asset classes that have remained propped up and really haven't come down in price. It's pretty much the last asset class that hasn't been hit yet by this market downturn and by this market correction. It all started with small cap companies and then high growth and then tech companies. And now finally, we're getting to large caps. But as you can see, thanks to Yardini research in the top graph, we can see that valuations are coming down for the largest companies finally. They've forever been propped up, it feels like, while the mid-caps and the small-cap companies, their valuations have been getting crushed for almost a year now. And this is something that I predicted would happen because it has to happen. Valuations just can't stay that high forever. They have to come down, and it appears like it's finally happening. On another note, the price of oil also appears like it's hit a tipping point. The price of oil is finally going back down, it appears like. Obviously, the price of oil has been on a tremendous run, and it's only been about the past week or so where oil prices have finally started to fall back down. So this could just be a short-term trend as a part of the longer bullish trend, but I have a feeling that the price of oil is going to consolidate in this area and maybe even fall a little bit further from here. But currently, oil is priced at $83.60, which is down from the high of almost $86 for oil. Lastly, and perhaps most importantly of all, I feel like the markets have hit maximum FUD, maximum fear, uncertainty, and doubt. Whenever you get a bunch of fear, uncertainty, and doubt, the markets overreact like they always do, and you eventually get to a point where even the worst news, if the worst news came out, the markets wouldn't fall any further because the markets are pricing in doomsday and the worst case scenario. So even if we get bad news at this point in time, it's going to be better than the worst case scenario the markets have been pricing in for the last 6 months or so. Think about it. Whether it's inflation, rate hikes, or the Ukraine and Russia debacle, there is just so much fear, uncertainty, and doubt in the markets right now. Eventually, the market just runs out of sellers. And as I already prefaced in this video, with short volume ratios on any given trading day, it appears like we are running out of natural sellers of stocks right now. And I've kind of been confused with the people selling out of all their stocks right now. People that used to say the best time to buy stocks is when there's maximum fear, uncertainty, and doubt. Well, guess what? There's maximum fear, uncertainty, and doubt, and doomsday, worst case scenarios being priced into the markets right now. I know Meet Kevin made a point that why would institutions buy right now ahead of CPI data? The reason they would buy shares right now is because of the valuations, but also because their clients pay them to be invested into this market. They're not paying them to be sitting on the sidelines, sitting on their cash, and seeing their cash get lost to inflation. These institutions are paid to be invested in this market. They're not going to wait 3 months to buy back into stocks. It's just simply not going to happen. So now you may be wondering what I think is going to happen to all of these negative catalysts, because certainly there's a lot of fear, uncertainty, and doubt, and certainly a lot of that fear, uncertainty, and doubt is true. They are catalysts that are currently affecting our stock market. I don't think they're going to blow up into thin air and just disappear by any means. And in fact, I think they're going to continue to affect our stock market. But as I already referenced, right now, I believe, according to my studies and a lot of different studies, that the stock market is pricing in doomsday and worst case scenario right now. And think about it. Even if we get this bad news with inflation or rate hikes, worst case scenario has already been priced into the stock market. Eventually, there's just going to be nowhere left for the stock market to fall down into. Eventually, we're going to hit that rock bottom. Right now, it's pretty clear that the stock market is pricing in 5 to 6 interest rate hikes this year in 2022. But I believe there's only going to be 2 or 3 rate hikes at a maximum. And the reason for that is because the economy is slowing down. And you never want to raise rates as your economy is slowing down because you will absolutely kill your economy. When I say that the economy is slowing down, it means that people are spending less money and they're also saving less money. And the reason I'm saying this is because we can go to Google Trends and see that the search term loan is at a low right now, lower than it has been in over a year. If we enter the search term iPhone, we can see that the interest in this search term is at lows, lower than it has been any time over the past 5 years. The same can be said about the Tesla Model 3 search term, where the interest in the Tesla Model 3 search term is as low as it was during the pandemic in March of 2020. We're getting back down to those levels, meaning that less and less people are going out and searching to buy that Tesla Model 3, or to buy that iPhone, or to borrow money using a loan to buy something they want, or buy something they need. So demand is pretty clearly slowing down right now. And the reason I believe that we're going to see less interest rate hikes than the market is currently projecting is due to this fact. I also think that the 2 to 3 interest rate hikes this year in 2022 will be of very, very small scale, less than the market is currently anticipating. And this is also because during 2022, it's pretty well known that the supply chain constraints are going to be put behind us. they're all going to be worked out, which means that a rush of supply is going to hit our economy. Once all these supply chain constraints are removed from the economy, supply is going to come rushing in. And if demand is slowing and demand is going down at the same time supply is rushing in, that generally means that there's going to be negative pricing pressure on about any good or item that consumers buy. So not only do you not want to raise interest rates when your economy is slowing down and demand is slowing down, but also these supply chain constraints going away is going to put a lot of deflationary pressure on prices. Natural deflationary pressure. And that deflationary pressure is going to directly offset inflation naturally without the Fed having to raise interest rates to offset that inflation. And in fact, here's my prediction. I'll say it now. I think that sometime over the next 12 months, we're actually going to see deflation year over year. Mark my words, I think I'm the first one on YouTube to say this, but I actually think we will see deflation sometime over the next 12 months. Another reason I see this as a bear trap right now is because it's pretty well known, even though I try and stay away from politics on this channel, that the Biden administration and the Democrats are in a bit of trouble going into the midterm elections. And the Fed is supposed to stay independent of the government, whatnot, but it just simply doesn't happen. So I believe that Biden and the Democrats are going to do anything in their power to prop up our economy and prop up their stock market in anticipation of the midterm elections. You'll see historically that whenever election season comes up, the stock market is generally doing pretty well. The bottom line is there's actually quite a bit that the government and the Fed can do to manipulate the economy and the stock market. And the Democrats, simply put, want a good economy and they want a good stock market going into the November election season, just like the Republicans would. So because of all of these reasons, I believe right now we are in a massive bear trap. And sometime over the next 2 weeks, I think we're going to find our bottom in this stock market. I think it's going to be a bumpy ride back up, but I also think it's going to be a quick ride back up because of the algorithmic trading going on and also because of the short volume in the market currently. Whenever a lot of short sellers get into the market, it generally means explosives for the bulls whenever the market turns back in the bulls' favor. But again, none of this is meant to be financial advice. I'm simply explaining my own thoughts, opinions, and ideas. It's up to you to come to your own conclusions about what I've said today. Again, if you guys are new here or returning and not yet subscribed, I would greatly appreciate you hitting that subscribe button down below. And if you enjoyed this video, please hit that like button down below. And don't forget to comment a stock that you've been buying up like crazy as the market continues to dip. With that, I hope you have a great rest of your day. Peace out.